All right. Today is Thursday, June 10th. This is a recap for the stock market activities today. What else? Let's start by the big number, the CPI number. The expectations were for a reading of 4.7% increase year over year. We got 5% instead, slightly above expectations. That was confusing to the market, to say the least. Don't get me wrong, the number is still large. This is the fastest pace of increase in inflation since 1992. This is not a number to sneeze at, but the cooks gave us a reading slightly above expectations. Not too hot, not too cool. Right at the sweet spot, keeping the market guessing and wondering whether this inflation is transitory or not. Keeping both arguments alive. And this is a very important key fact that you need to understand. But back to the number. Inflation is rising at the fastest pace since 1992. But the most important part is what was behind the rise of inflation, at least according to the cooks. You and I know that inflation is rising all around us, whether it is food prices, gasoline prices, home prices, goods and services prices, they're all rising all around us. But we have to play ball with whatever the Bureau of Labor Statistics and the Federal Reserve give us. In this case, once again, used car prices was the key behind the rise of inflation year over year by the tune of 5%. And of course, they're excluding energy and food prices because they're quote-unquote too volatile. Let me ask you a question. Isn't food and gasoline prices one of the most important expenses for all of us consumers from every household level? Record prices of used cars and trucks was the biggest contributor to inflation last month. Prices climbed 7.3% after a 10% gain in April. Now, the market always thought that the rise in used car prices is transitory because part of the reason behind the lack of production of new cars to the market is the chip shortage. Well, we know that the chip shortage is temporary. It is transitory. It will take time, but the production of chips will catch up with the demand, specifically if we see a crash in cryptos, for example, relieving the pressure on the supply chain of chips. In the meantime, consumers will have to resort to used cars, specifically used trucks, and that sudden surge in demand is increasing used car prices rapidly. The market believes that used cars price inflation is transitory. Once you have new supply to the market, the price pressure will be relieved. That is the assumption. I happen to disagree with that because say you are an executive at Ford or General Motors and you are watching consumers willing to pay 10, 15, even 20% premium over the sticker price for used pickup trucks. What does that tell you? The demand is too strong and the consumer has the disposable income willing and able to pay higher prices. And therefore, the price inflation will shift from used cars to new cars. Ford, General Motors, and the likes will increase prices on their new cars. So the price inflation will shift from used cars to new cars, so long as the underlying demand continues to grow. And what is the underlying demand, by the way? Why are people all of a sudden stampeding to buy pickup trucks? The reason behind that is the Great Migration. A lot of Americans during the pandemic moved from cities to the suburbs. We talked about Boise, Idaho, for example, moving to smaller cities, pushing housing prices higher in these smaller cities. But buying all of these houses will come hand in hand with buying pickup trucks. You can have a lot of projects and you need pickup trucks. What else contributed to the inflation number this time around? And here is the cooking, by the way. The cost of groceries rose 0.4% in May. The bad news is prices are likely to keep going up. The cost of packaging and farm crops have surged, and producers and retailers are likely to try to pass those increases along to the customers. Let me ask you a question. Does anybody believe this garbage, this bullshit that the cost of groceries only rose 0.4%? Here are the numbers from the same Bureau of Labor Statistics, aka the kitchen. Steaks up 6.1%, bacon up 10.7%, pork up 3.7%, sausages up 3.3%. What about fruits? Up 6.2%, milk up 4.4%, beans 6.7%, Apples 2.6%, oranges 6% year over year, lettuce 5.1%, gasoline 49.6%, appliances 12.3%, turkeys 4.5%, canned goods 2.2% higher year over year. Likewise, sugar prices are up 3.6% year over year. But magically, grocery store items only went up by 0.4%. Okay, you want to play this game? We'll play the game. Even with the cooking, this is the largest increase in inflation year over year since the financial crisis. You better hope that the Federal Reserve is right, because if they're wrong, this will be a historic inflation, the likes that we have never seen since the 1970s. And everybody's dismissive to the number, the market, and the experts, quote unquote experts. And the reason is, well, used car prices, that's transitory. Once the demand goes down and the supply goes up, after resolving the chip shortage, used car prices will go down, okay? And airfare tickets and gasoline, don't worry about that. These are just base effects because we're reopening. Therefore, it is reasonable to expect airfare prices to go higher. But here is the sleeping giant. We talked about this last night. Rents rose a modest 0.2% in May, leaving the increase over the past year at 1.8%. You gotta understand the manipulation here in these numbers and formulas. For example, in the final rent reading, cities like New York and LA carry a bigger weighting in the formula. And I showed you last night that rents in New York, LA, Seattle, San Francisco did not recover completely, but we are seeing a massive, rapid recovery in rent prices. The current median rent in New York City is $1,400. Let me ask you a question. Do you really think that the median rent price in New York City will stay at $1,400 2 months from now? Absolutely not. Furthermore, here it is. Rents have risen slowly, in no small part because of government restrictions on evictions. What's less clear is what will happen once the restrictions expire. Shelter is the single biggest cost for most consumers. California and New York are under an eviction moratorium. You cannot evict tenants, and there are rent caps. You cannot increase the rent on current tenants beyond what the government is allowing you. I live in the city of San Diego, California. We have a strict eviction moratorium. You cannot evict anybody, and you cannot increase the rent on your current tenants by more than the CPI reading. So for now, the CPI is reading 5%. That is the cap right there. You cannot increase rent more than 5%. However, if the unit becomes vacant, landlords are allowed to raise rents with no limitations. They can capture market prices. So what will happen is, the moment the eviction moratorium expires, landlords will make up whatever problem it is, whatever minor violation, and kick current tenants out, making these units vacant for new renters who are willing to pay market prices. This phenomena will push rent prices across the country significantly higher. And in the next few months, rent will start to surge higher, pushing the CPI reading higher and higher. And rent has a higher weighting in the CPI formula than used car prices. So the only hope here for inflation deniers, the Federal Reserve, and the Biden administration is that states like California, New York, and Washington continue to extend the eviction moratorium, limiting the number of evictions as much as possible. That will keep rent prices down overall, because while rents in Las Vegas, Arizona, Boise, Idaho, Austin, Texas are increasing rapidly, rents in the two largest states in the country, California and New York, will remain low. New York is a different story, specifically New York City, because the number of vacancies is already high. But there is no significant demand to move back to the Big Apple, at least for now. But as employees go back to the office, and we're hearing from firms like JP Morgan and Goldman Sachs saying we're going back to the office by the third quarter. No work from home. We're not going to do the Zoom thing. We're going back to the office. And therefore, these vacancies in New York City will be filled and rent prices will recover fast. California is a different story because it depends on the eviction moratorium and how long will that be extended. The bottom line is, inflation is rising. There is no doubt There's no ifs and buts about it. It is rising higher to levels we have not experienced in a very long time. So what was the market's reaction to this rise in inflation? We talked about the bond market. The bond market starting last week was already doubting inflation and trading as if inflation is cooling, not rising higher. And the bond market continued to act this way even after the number was released, confusing the majority of market watchers who believed that yields will rise higher naturally after a quote-unquote hot reading from the CPI. But remember, the expectations were 4.7. The number we got is 5%. And the argument for now is, well, the bond market has already priced that in. Of course, until yields blast higher again, and these same people would say, well, we don't know. We have no clue. We don't know why the market did what it did. And that's the truth. What about the stock market? Here it is, back to the Taylor Swift mode. Shake it off, baby. Shake it off. Dow futures gained 150 points, shaking off hotter than expected inflation report. The question is, why? Why didn't the market react the way we expected it to react? I gave you one argument. Used car prices are once again responsible for the rise of the CPI. The market believed since last month that the inflation in used car prices is transitory. I get that, but it doesn't merit the market's reaction. So what else? Any other theories on why the market reacted the way it is? We have investors like Druckenmiller, for example, saying that the market is not speaking right now on May's CPI data and will not until the Fed stops canceling market signals and at the point we will know. Blaming the Federal Reserve of market manipulation. Could that be the reason? We discussed two reasons so far. Number one, the market believing that used cars price inflation is transitory. Number two, the Federal Reserve manipulating the market. Any other theories? What about my theory? Remember that before the week even started, over the weekend I released a video asking the question, will the Nasdaq reclaim the market's leadership? Because as I discussed with you, the market has two roads to follow. One of these themes will be the theme of the year. One of these themes will outperform the other. Theme number one, the inflationary theme. Higher yields, we see reopening, reinflationary, and value stocks outperforming. So far this year, this theme has been winning. The other theme is the disinflationary theme, where we see lower yields, we see technology, stay-at-home, and growth stocks outperforming. At least for today, the market decided to go with the disinflationary theme. Evident from this tweet. Yesterday, I tweeted this. If you believe that the CPI number will come out cool, which is the bonds market consensus, you're betting for the TLT, Triple Qs, the Nasdaq, the XBI, the Biotech ETF, and RKK, ARK Invest ETF to go higher. If you believe that it will come out too hot, you're betting for the TBT, Treasury Yields, the KRE, regional banks, the SQQs, the inverse of the Nasdaq, the XLI, Industrials, and the WP, which is the dollar index, to go higher. Let's see what happened today. The TLT finishing the day higher. Likewise, the Nasdaq finishing the day with gains of over 1%. What about the XBI, the Biotech ETF, also closing the day with gains exceeding 1%. The RKK, ARK Innovation, closing the day with gains of almost 2%. What about the other side? The TBT closing the day down by more than 1%. Regional banks, the KRE, down big by about 2%. The SQQs, the inverse of the Nasdaq, down by about 3% or so. The XLI, Industrials, down by about half a percentage point. And lastly, the dollar index remained flat. So the theme is clear. The market went with the disinflationary theme. Why? That remains the question. And I gave you two theories that was discussed in the financial news media today. Number one, believing that used car prices are transitory. Number two, believing that the Fed is manipulating the market. And here's another one. Number three, that inflation is peaking, which is garbage. And you have to be an amateur to believe that one. My interpretation of the market's reaction is the following. Going into the week, we were assuming that the Nasdaq will outperform. It just needs a confirmation, and the Nasdaq will reclaim the leadership of the market. This is how the market was shaping up before the week even started. And when we look at the inflationary names, for example, Caterpillar, here is a weekly chart. This is a poster boy of the inflationary stocks. You look at the momentum indicators, the MACD and the RSI. They're peaking and they have reached extreme highs, meaning that this trade is overcrowded. We will need a super hot CPI reading for investors to continue to buy Caterpillar. When the number comes confusing, inconclusive one way or the other, suggesting inflation, which we know inflation is rising higher, but also keeping that little room for doubt that inflation could be transitory. You're not going to have a conclusive answer one way or the other. For me, I have the conclusion. For the market, that was not conclusive. And that's all what matters. And the algos decided that these trades, the likes of Caterpillar, are overextended, overbought, overcrowded, and appreciated significantly since the beginning of the year. Perhaps it is time to take profits out of these trades, at least for now, at least for today. So we saw names like Caterpillar down. Here's another one, Alcoa, a poster boy for the inflationary stocks, also down. But look at where the MACD and the RSI indicators are reading. This is overcrowded, overbought, overappreciated, and overloved. And that is for a solid reason. Inflation is rising higher, but perhaps it is time to book some profits. Likewise, here's another one, the SLX, the steel ETF. A very hot trade, but also peaking. The technicals are overextended in these inflationary stocks and inflationary themes. Another one, the XLF. The financial sector also peaking, very extended from a technical level, and we saw a big pullback for the XLF today. Meanwhile, the poster child for the disinflationary theme, and these names got hammered significantly since the beginning of the year as inflationary fears started to grow. These names caught a bid today. Whether that is sustainable or not, that's a different story. But my interpretation of the action today in the stock market goes as the following. The market was confused by the number. What do I make of a number that is slightly hotter than the expectations, signaling higher inflation, but also leaving room for doubt that it did not come out too hot? For example, 6%, 6.5%. It came a touch above expectations. The market was very confused, going up, going down, not sure of what to do. So in my opinion, the market decided to go with the technicals, take profits from the overextended trades, and perhaps bid the laggards, the technology names, the high multiple names, higher at least for the day. The sustainability of the market's decision today is up for grabs because for all you know, we wake up tomorrow, the market processes the information and it decides to do a 180 saying, you know what, we don't think inflation is transitory. And here it comes, stocks like Freeport-McMoRan, Alcoa rise higher. Meanwhile, the stocks that caught a bid today, the technology and momentum names, reversing lower. Therefore, wait for the knee-jerk reaction to be over. Wait for the market to process this information tomorrow and over the weekend and come up with a conclusion next week. For now, this guy you're listening to did not change his strategy one way or the other. The information I got today only confirms my stance that inflation is rising. It has some transitory elements, but in the overall picture, this is not transitory inflation. And the reason is we have already reached the wage inflation stage. There is no going back after wages have already increased. You're not going to pay people more and then 6 months from now say, oh, folks, never mind, we're going to reduce your salaries again because inflation was transitory, you know? That's not going to happen. Likewise, when firms raise prices and consumers absorb the price increases, these are not going to be transitory. These are going to be permanent. But I have to be patient and play this game and dance back and forth with the market's expectations and the transitory argument and trade accordingly. But all in all, this will be a battle based on the flow of information. If we get more information the next few days and weeks, any information suggesting that inflation is not transitory and the market will revert back to the inflationary theme. And therefore, my advice is hopping from one theme to the other will prove fatal because the market will be extremely volatile depending on the flow of data. Therefore, sticking to your current beliefs, but trading the market in the meantime, meaning you're not going to make major moves in your portfolio one way or the other based on this CPI reading. But you can trade the market's reaction. For now, the bond market is saying follow the deflationary theme. Today we had yet another bond auction for the 30-year and the demand was high, believing that yields are not going to go higher and perhaps inflation is transitory. That is the thinking right now. So I'm not changing my portfolio. I am overweight the inflationary trade, but at the same time I will trade via options and short-term trading strategies based on the market's guidance. If the market takes its time over the weekend processing the information and come back next week, still following the disinflationary theme of appreciating the Nasdaq and the high multiple names, and these are the names I will be buying calls for. At the same time, I will be selling or buying puts in my current inflationary stocks positions, the likes of industrials, financials, etc. Anyhow, we have a lot to cover during this video, so that is enough talk about the CPI. Let's go ahead and cover the market's performance today. And here we go! The Dow Industrial Average closing in the green by 19.10 points, or a gain of 0.06%. The Nasdaq closing in the green, leading the gains by 108.58 points, or a gain of 0.78%. The S&P 500 also closing in the green by 19.63 points, or a gain of 0.47%. What about the sector's performance today? Leading the pack, and this is important, the neutral sector of the market, healthcare, and capturing the gold medal. Number 2 for the silver, technology. Number 3 for the bronze, communication services. Meanwhile, the laggards for the day led by industrials, financials, and consumer cyclicals. What does that tell us? Suppose the market is believing the transitory argument or believing that the CPI reading is peaking and it came out cooler than expected. Perhaps the market was pricing in a 6% reading and it got 5%. I'm saying that hypothetically. The first part of the trade will be dumping the inflationary stocks, and in this case, you saw financials and industrials leading the decliners. So we have a check mark on that part. But part number 2 of the reaction is appreciating and pushing technology stocks significantly higher. That part was mild. Yes, technology closed at the second place for the day, but I was expecting a massive pop in the Nasdaq. I did not get that. That keeps the mystery alive. Will this reaction be permanent or will it be transitory? What about the market spread with the advance and decline ratios? Starting with the NYSE, 47% advancing versus 51% declining. The Nasdaq, 47% advancing versus 50% declining. Pay attention here. If inflation is transitory or cool, we're expecting the Nasdaq to blast higher significantly. Yes, the Nasdaq closed in the green, leading the market, but under the hood, the advance to decline ratio, the breadth, not so good. So watch out for the knee-jerk reactions here. For all you know, we wake up tomorrow and the market does a 180, erasing everything altogether. Moving on to futures. Is the futures market confirming the bond and equities markets? Not really, because the picture is mixed. Matter of fact, crude oil prices closed the day with modest gains. Likewise, for softs, we saw gains for coffee, cocoa, and cotton futures. Meanwhile, we saw big declines for lumber and modest declines for OJ futures. Remember, lumber, copper, and corn, the axis of inflation. Speaking of, copper is down, but gold, silver, platinum, palladium all closing flat for the day with modest gains. So we have oil not confirming the move of the stock market today, but we have lumber and copper confirming the move. What about meats? Also flat. The market is confused, not sure of what to do. Perhaps it's a knee-jerk reaction and the commodities market is being more mature, at least for meats, not making a big move one way or the other. Likewise, what about grains? We have declines for oats, soybean oil, soybean meal, and soybeans futures. Meanwhile, gains for canola and corn futures. And the factors supporting the inflation in commodity prices, specifically in grains, are not moving away. They're not transitory. Yesterday, we talked about the drought in the western United States, and now the picture is getting even more dire. The Hoover Dam Reservoir hits record low in sign of extreme western United States drought. Let me ask you a question. Is this drought transitory? Perhaps it will last for a season, but that means that we're going to have food inflation, and that inflation might not be transitory. After all, what is transitory? The Big Bang was transitory. Does that mean that we have to dismiss the Big Bang? When they say inflation is transitory, what does transitory mean? 1 month? 2 months? 6 months? A year? 2? Perhaps a decade? Who knows? What is transitory? The Federal Reserve says, we're not going to talk about talking about any guidelines. We're just going to keep you in the dark. When we say transitory, we mean transitory, whatever that means to you. But we're not going to say what it means to us. You like playing games? Because Papa Jerome does. And this is all done to manipulate the stock market higher. If there were honest people, the Federal Reserve would have issued clear guidelines saying, look, by transitory, we mean a year and a half. We mean 6 months. That way, we're going to have a parameter and a threshold to judge whether inflation is indeed transitory or not. But the Fed likes to play this flexible game. Let's say we're in September or October of this year and inflation is still rising. The Fed will use the same argument. Oh, but it's transitory. Okay, let's play a game. You want to play a game? Let's play the game. You want to push the NASDAQ higher? I got no problem with that. I'll buy calls and make money off it. But in my heart, I know that you're bullshitting and you're manipulating the market to serve your sponsors' purposes. Lastly, before we move on from the futures market, when I say there's money in shit, in horse manure, cow manure futures, is the future, bro. Forget about AMC, forget about the meme stocks, that's garbage. You want to talk about the future, look no further than poop, because here it is, how farmers are using cow manure to power crypto mining operations. There you go. We're going to have tulips powered by cow manure this time around. So find yourself a cow farm, put your blindfold on, and stampede Naruto style heads first and collect that cow manure. Because that's the future, bro, and it is not transitory. Moving on to the options market, aka the big casino. What's going on in the casino? Number one, the hottest table for a while, AMC. We're seeing the options volume rebounding higher. Does that mean that the stock has another leg higher? Perhaps, but wait for it. AMC leading the casino with about 1.7 million contracts traded today. Only about 56% of those were calls, so a lot of that volume was put options buying. What about Apple at number 2 with about 1.2 million contracts? About 75% of those were calls. Tesla, the souffle, at number 3 with about 950,000 contracts. About 42% of those were calls. Are we seeing a reversion from the meme back to the NASDAQ, the big cap technology stocks? That certainly could be the case. And pay attention to this. The IV rank for Apple, Tesla, Amazon, pretty much at 0. So there is no love for the options on these names because everybody's busy chasing the options on meme stocks. What does that mean? Translation. It means that this is a good opportunity to buy options, calls, or puts on the classic names, Apple, Tesla, Amazon, while no one is paying attention. What about the unusual trades taking place in the options market today? Starting with the ticker EWZ. This is for the Brazilian ETF, and they're making a bullish bet here by buying the 43.5 calls, expiration date July 16th. With expectations that the name will rise over 6% by then, they paid about 45 cents apiece to enter this trade. All in all, bringing the total to about $2 million. I have been avoiding the Brazilian market, and the reason is the political instability and the fact that the country hasn't handled the COVID-19 crisis properly. But perhaps there is a light at the end of the tunnel, and the EWZ, the Brazilian market, is a buy. This is at least what this trader is saying. What about the trade for the ticker DBX? This is for Dropbox. They're making a bullish bet here by buying the 33 calls, expiration date August 20th, with expectations that the name will rise by about 11% by then. They paid about $1.10 apiece to enter this trade. All in all, bringing the total to about $1.5 million. You have hedge funds and the likes starting to become bullish on this name, Dropbox, and it is catching a bid. What about GME, GameStop, down big today, but somebody's bidding for a rebound by tomorrow. Here comes the casino. They're buying the $250 calls, expiration date June 11th. That is tomorrow, just in case you didn't know. And they are expecting GME to rise by over 13.5% by then. They paid about $5 a piece to enter this trade. All in all, spending about $4 million for this trade alone. Why not just go to the casino, like an actual casino, and put it all on red, and you'll know right away whether you won or lost. But this is gambling that's going to keep you awake all night long. This trader is sitting all night long with a big jar of Vaseline, updating the futures chart being stressed out to the limit, and who knows, the trade might not work after all. Just go to the casino, put it all in red, and see what happens. What about the trade for the ticker mRNA, Moderna? Perhaps the name has topped here. We are at peak vaccine because they're making a bearish bet here for the name by buying the 190 puts, expiration date June 18th, with expectations that the name will drop by over 12.5% by then. They paid about $1.10 a piece to enter this trade. All in all, bringing the total to about $600,000. Lastly, what about the trade for the ticker HD, Home Depot? And this trade is significant because this trader is making a bearish bet against the name, buying the 290 puts, expiration date August 20th, with expectations that the name will drop by over 6% by then. They paid about $5 a piece to enter this trade. All in all, bringing the total to about $2.5 million. Why is this trade important? Because Home Depot has become a proxy for the lumber trade. And if this particular trader is agreeing with the market that inflation is transitory, we will see lumber prices going down. At least if the housing bubble is about to cool off, then this trade makes a lot of sense. Moving on to the heat map analysis. Right away, the reaction of the market is very clear. Dumping financials, regional banks, big banks, it didn't matter. Industrials underperforming. Materials, mixed picture, but underperforming, specifically when we talk about steel, copper, agricultural stocks, the inflationary stocks, all down. Energy, mixed picture, holding. Meanwhile, the tech sector performing as expected. We're seeing gains for the software names, semiconductor names, but Apple remains the mystery. Remember what I say, as Apple goes, so will the Nasdaq. Well, Apple went down today. It did not go higher, so that remains the mystery. But once again, I'm not impressed by this reaction. I was expecting massive gains. I was expecting a lot of short covering in the Nasdaq and the tech name, the high momentum names. That did not happen. We saw a bid for these names, outperforming clearly, but it's not a conclusive reaction, which opens the doubt that this is a transitory reaction, a knee-jerk reaction that will be reversed soon, absent of a confirmation from the technicals. What about the themes analysis? Starting with the reopening trade. No love for the reopening trade today. Not interested in the inflationary theme, and we're seeing losses for the majority of these names. But the key word is modest losses. We're not seeing an exodus from these names in favor of the Nasdaq and the mania names. The market's reaction is inconclusive. What about the high inflation stocks? As expected, we're going to see losses, but the losses are modest. Alcoa down about 1.5%, and only Deere and Martin Marietta declining by over 2%. But again, no mass exodus here. The market is still confused. It decided to react one way, but the sustainability of this reaction is up for grabs. What about the low inflation stocks? The high multiple mania names outperforming today, whether we're talking about Zoom, Square, Shopify, Dash, ServiceNow, Tesla, DocuSign, ARK Invest, all closing in the green with noticeable gains. The question is, has the market made up its mind to favor this particular trade? Because as traders and investors, we want to know if this is the way the market will take, at least in the short term. We want to know so we can buy and trade these stocks. For now, we don't have a confirmation. I will be waiting for a confirmation next week, not tomorrow. Moving on to the charts analysis, starting with AMC. And this will be the last day we're covering the chart of AMC and any meme stocks, unless there is a significant development. A lot of you complained, stop talking about meme stocks, we don't care. I hear you. It's an important story. We'll cover it until it fizzles out. For now, it looks like AMC and the meme stocks are setting up for significant losses. We had the first phase, the big pop higher. This is the phase from a psychological perspective where traders and investors, specifically retail, start to stampede, pouring a lot of money, buying call options, buying stock. And we're talking, I know from my personal experience, people in my circle, rational people, not stupid people, who use their life savings and significant amount of money that they cannot afford to lose, and they bought AMC stock. All in. And what you'll find out is the following. After the accumulation phase is over, which is the massive pop higher, remember, stocks go up if there are more buyers than sellers. And during the accumulation phase, there was massive amount of buying, billions and billions and billions of dollars. But to sustain that move higher and push the stock to the moon, as the apes would say, you need to sustain the same momentum. You need retail traders and investors to continue to pour massive amount of money day after day after day. And therefore, this has the attributes of a pyramid scheme. Because you see the apes going all over the web trying to recruit new apes. Buy AMC, bro, to the moon. They need new blood to buy the stock and options. Otherwise, the stock will collapse. It will be a pump and dump. And the problem is that the majority of these apes are already all in. They don't have disposable money to buy the dip or buy call options. They're already locked in. They're in the hole, screaming and shouting for bypassers to join them. But bypassers are looking around. A, the options premiums, the call options premiums are too expensive. B, the stock is garbage. It's a company that should go bankrupt. Number 3, it's highly volatile. It's down over 40% from the highs. There's a lot of fears. No thanks. We're not joining. Well, what happens if new blood doesn't join the current apes huddling or hoodling, as I like to say? The stock goes down because you need allies to push the stock higher. The first phenomena of GameStop earlier this year, retail traders had an ally, and that ally was short sellers. The short float was over 100%. So after retail traders are done buying, they're already locked in, they don't have any disposable income to buy the dip. Well, guess what? Shorts were buying the stock and pushing it higher and higher and higher. Retail traders had an ally in shorts. Unfortunately, they don't have the same ally in AMC. The short float is only 20%. The stock price is low, relatively speaking. It's trading around 50, 40 bucks. That's not going to force shorts to cover. You need to get the stock to be over 100, 150, 200, and then it becomes a big price tag. Shorts cannot keep up with margin, and they will be forced to cover. But even then, it's only 20% of the entire float. The question is, can the apes push the stock all the way above 100? That is doubtful. And the reason is they're already all in. They cannot buy more. And there are no new apes joining them. They have no ally. In addition, certain apes are abandoning the ship. They're moving to Clover. They're moving back to cryptos. They're moving to whatever. Doesn't matter. So long as they're moving away from AMC, booking their gains, the paper hands, the ones that actually make money, and they're moving on. The stock goes down. Anyways, this is a psychological analysis of the current standing of AMC. Enough said. What about the SPY? 30 minutes perspective. We talked about the level of 423, consolidating around that level over and over and over again. Today, we saw the big gap higher, capturing 423 for support, and then going all the way down, closing the gap, and reconfirming 423 for support. In my book, this is bullish behavior. And the expectations are the SPY should be able to at least close the week above 423. If it pulls back tomorrow, then the reaction we saw from the market today was transitory. Perhaps the SPY will go back to consolidation mode. What about the daily chart, the continuous contract for the S&P 500? The chart has been consolidating underneath 4,232 day after day after day, gathering the energy and waiting for the catalyst to crack above that level. And today was finally able to do so by a notch. And therefore, the weekly closing is extremely important. Here is the 30 minutes chart. We're looking for a weekly closing above 4,232. That will confirm the move that we saw in the market today, and it will signal higher prices coming for the S&P 500. What about the NASDAQ? 30 minutes perspective. The SPY had 432 to battle with. The Triple Qs has 340. And today did the same thing, going all the way, facing the resistance of 340, getting rejected, pulling back, but gathering enough energy and pushing higher and marking 340 for support. Slightly, but it counts. The question is, will the weekly closing tomorrow confirm 340 for support, or was the action in the NASDAQ today once again transitory? What about the daily chart for the continuous contract? The NASDAQ rising higher, and the expectations are that the NASDAQ will be able to crack above 14,000 once and for all. The question is, will it close above that level for the week? And if that is the case, then that will pave the way for a massive rally for the NASDAQ in the next few weeks, and perhaps paving the way for the NASDAQ to reclaim leadership of the market. What about the IWM? Not looking good here, breaking away from the channel in a bear flag formation. And the reason is we have the meme stocks underperforming today, along with the reopening stocks, the darlings of the IWM, and therefore it is trading lower. If that continues to take place tomorrow, we will see the IWM perhaps dropping all the way down to the support level of 223. If meme stocks rebound, so will the IWM. What about the daily chart for the RUT, the Russell 2000? For now, the bulls have the advantage. The question is, will they have the advantage by the weekly closing? We'll see. What about the Dixie, the dollar index? And this is the only unsolved part of the puzzle. The market reacted as if the inflation number came out too cool, but the dollar did not react one way or the other, as if the dollar is trying to send a message saying, I don't care about the bonds market reaction, nor do I care about the stock market's reaction. I have a mind of my own, and you will see my reaction very soon. What about gold? What's going on here? Gold rising higher slightly. Ask yourself a question. Why is gold rising higher when yields are down? When the market is celebrating a transitory inflation? When the market is in deflationary mode, why would the perfect hedge against inflation, gold, rally higher? There are many theories here suggesting that gold is tracking real yields, etc., etc. For now, my own observation is, since the quantitative easing era, gold has an inverse relationship with treasury yields, meaning if inflation rises higher, gold goes down. And until and unless this inverse relationship is reversed, I'm not buying that gold is the perfect hedge against inflation. What about yields? The chart of the day and the chart of the week, by the way. Initially, as the number was received, the CPI number, yields blasted higher. But immediately, doing a 180, and we saw a massive flush down all the way till the end of the day. And the 30 years bond auction did not help the move in yields. It added more downward pressure on the 10-year Treasury yield. What do we make of this? My threshold, the line in the sand, is 1.5%. If what we saw today is a trick and the market is about to do a 180, going back to the reflationary theme, then I want to see yields closing above 1.5% by the end of the week, meaning by tomorrow. And if that doesn't happen, that will be a confirmation that the market is indeed believing the transitory argument, and we will see the Nasdaq reclaiming leadership of the market. What about the TLT? We have a bear flag formation from a weekly perspective that is still here, but the chart is making higher lows. We did not see the massive impulsive pop higher, triggering short covering, at least not yet. That keeps the mystery alive. Is the market's reaction sustainable or not? What about the VIX? The VIX is giving confirmation that the SPY should go higher. The VIX dropping by about 10%. For now, looking at the technicals, this is yet another confirmation that the SPY will make all-time highs. This is the assumption. The weekly closing remains the most important factor to watch for. A lot of confusion, a lot in the mix, but by tomorrow, we will have at least more clarity on what's going on and what the market is thinking. The reaction of the VIX will be extremely important. What about Apple? Sliding lower, closing the gap, but stopping right there. We did not see the reaction from the gap. Is Apple thinking about going higher or going back to 125, the level of support? On surface, the Nasdaq is going higher, and the market is not worried about inflation anymore. But the devil is in the details. And the devil this time around is Apple. As Apple goes, so will the Nasdaq. This is the most important name in the entire technology sector, the biggest stock in the world. And so far, at least today, Apple is not confirming the move in the Nasdaq. Yields are confirming the move in the Nasdaq, but Apple is not. What about Tesla, the souffle? Having a decent day, and that was expected the moment we realized that the market will react in favor of the disinflationary theme. However, the threshold remains 629. If Tesla closes above that level by tomorrow, then the likelihood is that Tesla will continue to rally higher all the way to 679. Remember that Tesla has an event where Reverend Elon Musk will reveal a new model. It's not really a new model, it's a new tier, the current model. And they have new innovations, 21st century kind of stunning innovation. For example, adding a karaoke option in the car. Wow, this is karaoke optimism. Should we add another $100 billion to the company's valuation based on this feature? Because when I debate the culties, they say, you don't understand, bro. This is about the future. Tesla's expensive because it's not a car company, it's a software company. It's a robotics company. It's a self-driving company. It's a robo-taxis company. Well, where are the robo-taxis, right? But perhaps the culties have a new argument, which is it's a karaoke company. That's going to be worth what? 200 billion? Moving on to tulips, what about Bitcoin? Not doing anything today, but outperforming the rest of cryptos. A matter of fact, the momentum indicators remain positive. We have a positive divergence in the MACD and the RSI. I'm a spectator here, and I'm waiting and watching for BTC to climb all the way to 42,000. That will be an epic battle, and if that is confirmed for support, then we'll talk. For now, the break could happen either way, breaking the support of 30,000 or breaking the resistance of 42,000. The momentum indicators are suggesting to me that the break could happen first for the 42,000 resistance level. We're skipping Doge. What about ETH, Ethereum? Not looking as good as Bitcoin. Matter of fact, closing below 2,500, not by a lot, but this was an important level to keep. So which one is telling the truth? Is it Bitcoin or is it ETH? Who's telling the truth? The Fed or inflation? Who's telling the truth? The Nasdaq or the dollar index? Who's telling the truth? Commodities or yields? This is the dilemma we're in. No clarity whatsoever, and we have a confusing action in the market. All of what you can do right now is wait and see. Wait and see what the market wants to do, and then follow through. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the University of Michigan consumer sentiment. That will be important, but the most important thing to watch is the market's reaction. Are we going to have a confirmation of the action we saw today? I'm watching the TLT. I'm watching the XBI. I'm watching the Nasdaq. I'm watching ARK Invest. I'm watching yields, the dollar. I'm watching gold because the weekly closing will be extremely important. Will it confirm or deny the action we saw today? But the take is the conversation, the debate regarding inflation has not been settled yet by the CPI reading we got today. And this is exactly what the market wanted. This is exactly what Papa Jerome and the Federal Reserve wanted. They wanted to keep the debate alive because so long the transitory argument has some legs to stand on, they will have lots of flexibility, and it will give the stock market a reason not to crash, a reason not to panic. When does the transitory argument dies once and for all? Wage inflation. They cannot tolerate everything besides wage inflation. If that enters the picture, then the transitory argument goes down the toilet, and therefore the market will continue to be extremely volatile, specifically every time we get economic data regarding wage inflation. And therefore, I'm sticking to my gun. Same portfolio. No major moves one way or the other. I'm not making any moves based on the market's reaction today. Anyhow, thank you for listening. That's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.